Alright, everybody. Welcome to Rebel Trading Group Podcast, episode 8, I believe. Let's see. Yeah, episode 8. Today's date is April 8th, 2018. It is Sunday morning. Getting to you kind of late on the week. We are pretty busy people. I work full time. Jason works full time. Today, Jason is not with us. He is on vacation. I can't remember if he said he was on a cruise or at a wedding. Regardless, here I am, broadcasting to you live from Panama City. Um, yeah, I had a great week. I beat the market's ass. I was up a total of 19.88%, while the market did not do well. It had a very volatile week. The Dow Jones on the week was down 0.58%. It had a pretty good week. It had a good rally during the week. Regardless, it was down 0.58%. The S&P 500 was also down a full 1.818%. The Nasdaq was down. Well, it was the worst performer of the week. Is down 1.52%. Let's see, Bitcoin. Right now, it's priced at $7,071, up 2.61% on the 24-hour graph. Let's see what the 7-day week looks like since we're at the end of the week. Still down from the past highs. It looks like it's about to rally up, about to do a bull run, but you never know with Bitcoin. It's one of the most volatile assets out there at this current moment. We had a pretty crazy week. We had job reports or labor reports coming out on Friday. We'll go over that. Let's go ahead and jump into market news with Nate. Well, here I am. So first in the news, we're gonna go with the jobs reports. NPR is reporting it was our 90th straight week or 90th straight month, 90th consecutive month of of net gains of employment. The net gain for March was 100,000 new jobs added to the market. It's not great. They were expecting a lot more, and they were expecting unemployment to drop to 4%, and it's only dropped to 4.1%, or it's only at 4.1%. So it's not great, but we're still doing okay. It's consistent. We have consistent job growth, so that's good for America. That's good for the U.S. economy. When there's jobs, that means the economy is doing well. Theoretically, that's the idea. What else is in the news? Tariffs. More tariffs. Our commander in chief, Donald Trump, President Trump, is talking about adding more tariffs. We saw Friday. Dow Jones was doing good on Friday. Let's take a look at that real quick. It had a good morning. It looked like it was going to do well. And then Donald Trump tweeted he was going to add $100 billion more in tariffs to China. If we kind of think about this, it's kind of like Donald Trump's playing a poker game, and he's got his chips on the table right now. So we look at his first tariffs. He said steel and aluminum, and he said $50 billion worth of steel and aluminum tariffs towards China. And China retaliated and imposed tariffs on wine, pork, and pipes. I guess I don't know. And then Donald Trump then announces his new tariffs on IP and electronics and all this new stuff. He got upset about them stealing IP theft or them doing IP theft. And then China then calls and says, okay, well, we put these tariffs on with soybeans, cars, chemicals, chickens, counters. And then Donald Trump on Friday says, well, I'm going to raise the bet to $100 billion more dollars. And I don't know what the tariffs are on this time, but regardless, it raises it up $100 billion. And it's this big old poker battle between the United States and China, and it's scaring a lot of investors and a lot of institutional investors, especially a lot of mutual funds and hedge funds that use equities in these also agricultural commodities as ways to make money. These people are scaring these people because they're not really making money. When you have a trade war, one of the assets or both of the assets look less attractive. You're raising the price of your assets in your country, which makes them less attractive to other people that want to invest. I don't know if I did the day for each. Let's go ahead and do the day for each index. The Dow Jones was down 2.35%. I think that's what brought it down for the week, definitely. S&P 500 on the day was down 2.2%, and the Nasdaq down 2.5%. The tech stocks have not been doing good, especially with Facebook coming in hot with the stealing your data thing. So that's not good. I think Facebook's gotta get over this hump before they start doing good. So maybe think about shorting or not investing in Facebook for a while. So today I was going to talk about some definitions, and I guess I will start going over some vocabulary, but I'm going to go over risk and how you should assess your own personal risk. So risk is defined as exposure to loss resulting from numerous market and economic and company specific causes. Um, Risk can come in various amounts of forms. You of course have your own market risk. That's just general. The market in general has its own risk. When you enter, you can't always expect to have returns. They have those statements that say previous performance does not reflect future performance, which is true. Just because you have a 5 year gains does not mean you're going to have another 5 year of gains. There's risk involved entering the market. So market risk here, I'm going to just read this off as defined. Defined as the risk that prices will decline, reducing the value of stocks potentially for many months. Market risk is the best known and understood form of risk. So don't go into stocks thinking that you're going to automatically make money. We talked about a lot of these risks, like liquidity risk, and which involves with supply and demand. If there's no demand for a stock, let's say, then there's a risk involved with that. That increases the risk. That means you don't have much more potential to have growth. If there's not a lot of supply, you have more risk of that, less growth. Here's leverage risk. Leverage risk is one risk that I definitely experience, especially with a leverage fund, a 3x leverage fund of the Dow Jones. When it does good, it's awesome, but when it goes down, it's 3 times down. So it hurts. It hurts in the butt, man. What else? Risk. Knowledge and experience risk, which is one of the reasons that we're sort of here to talk about stocks and investing in general, so we can kind of educate you and get you a kind of a background on all this. So, anyways, knowledge and experience risk, that's one of the reasons we're here, to kind of get you in the know of how things work, so you don't just blindly say, Coca-Cola, that's a good company. Regardless, it might be a good company in general to buy, but you don't want to just willy-nilly go off the say, like the other day we had Under Armour. Under Armour's, they've got really fancy. That's a good way to think about it. If something looks nice, you don't want to just buy it. You don't buy your car just because it looks nice. You want to buy it because it has a good engine, good warranty, good reviews. You don't want to buy a car just for the cup holders. You don't want to buy a stock just because of the name. You want to make sure you know what you're talking about or what you're getting into before you end up buying something. Let's see what else we got here. One thing to try and avoid that risk, we talked about this before, is paper trading. Jason has done paper trading before. I've seen his what do you call them, graph paper and his Excel sheets to show when he would buy. It's basically saying, I'm gonna buy the stock here, and you put it down on your paper. You say, for example, Coca-Cola KO, and you put KO. That's the name of the symbol, and you say, I'm gonna buy it today on this date, and you write the price down, and then you just sit there and wait. And you have no risk exposure to it. You have no exposure to it, but you say this is how you would do it. And it's basically practicing. Is what you're doing, and you can do that with Investopedia's thing and all this other stuff. Any other kind of simulations that give you less risk exposure, but still the experience you need to kind of get in. Another risk we have is sector risk. We've also talked about this a bit. When you're looking at sectors, There's some sectors that do really well, some sectors that do really bad. There's some sectors that are cyclical, and you can time them. Theoretically, you can time them. That's the idea behind a cyclical sector. Um, and there's risk involved in each sector. Um, for example, the steel industry. There's risk involved in the steel industry whenever there's tariffs coming in. And that leads us into our next risk, which is political and economical, or what is it called? Political and economic risk. Here's a definition for that. The risk, which is the risk that outside influences, President Trump, for example, may affect stock valuation. Political changes, either domestic or international, China, may curtail activities or affect customers' economic activities. Their activities may slow down production, prevent expansion, or prevent companies from hiring and retaining employees. We're in a perfectly good example right now with tariffs. We see that affecting a lot of steel and agriculture sectors. So you got to look at these sectors and say, wow, are they being affected by this political influence? Let's see. We talked about liquidity in our liquidity episode, so check that out. Let's see what else. Inflation risk. That's a good one too. This will kind of go. We'll kind of talk about inflation more in our forex episode. But let's see what it says. Inflation risk is the risk of losing purchasing power in money as a consequence of rising prices over time. For investors, inflation requires ever higher returns on investments to offset the effects of inflation. So you got to watch out for that. If the price of the dollar is just absolutely rising, you're losing value in the actual dollar. Things are becoming less valuable. We don't really need to worry about inflation risk because we have the Fed, the glorious Fed, keeping inflation down with interest rates. As inflation rises, the Fed likes to increase interest rates to kind of like push down inflation. So you don't really need to worry about that. That'll kind of wee its way out with the Fed. Even though I don't like the Fed at all. I think they're cockamamie con men. The last risk that I'm going to talk about is fundamental risk. And this is a pretty good. We'll go into this in our fundamental episode, and this kind of has to tie in with knowledge and experience risk. Fundamental risk is defined as the risk that financial reports on which investors rely may not be accurate and might even mislead investors in the extreme case. We talked a little about this in I forget one of our prior episodes about earnings report, and they're super flowered. Comstock Mining, for example. I've listened to one of their earning reports, and I've read their earnings reports. And they say we're adding, I don't remember what it was, like 10 new mining sites. Sounds great. But in the end, it turned out their earnings report was down. Their earnings per share was down. It's not good for investors. Their cash flow was down, or something like that. You need to pay attention to these fundamental key ratios, or as Jason likes to call them in Robinhood, the Jason Bessing Instametrics, the gluten-free Jason Bessing Instametrics. So check those out. So be sure you know your fundamental risk before entering any kind of asset. Fundamentals are different for each kind of asset, especially for, let's just say Bitcoin. The fundamental really would rely on the blockchain, the underlying fundamentals. That is the blockchain. And any other cryptocurrencies is their kind of how their blockchain operates, I guess. For stocks, it's totally different. There's tons of metrics you can look at. Gluten-free Jason Bessing Instametrics. Again, we'll go into more of the fundamentals in our fundamentals episode coming up soon. For Forex, it's definitely interest rates is the bread and butter for fundamentals there. So you just need to make sure you know what your fundamentals for your asset before you go into buying it. Let's see if there's any more. Risk tolerance. This is one of my favorite things to talk about with risk. Here's the definition of risk tolerance. The degree of risk appropriate to appropriate to each individual based on experience and knowledge, available capital, income, and willingness or unwillingness to take chances. So let's kind of go through each one of those. Experience and knowledge, we kind of already went over that. How much do you know? How much base information do you know about investing? Is it your first time investing? Your risk tolerance is probably pretty, I would say, low. Is that the correct word? You're more of a risky person doing that. Let's see what else. Available capital. Available capital is kind of the bane of a trader's existence. Um, I read this book, and one of the things they kind of key pointed on was capital lock, a thing called capital lock. And I go a lot of smaller accounts go through capital lock real quickly. You know, you buy your shares. You buy your index funds, you buy your ETFs, and let's say you have only $100 to spend in investing, and you buy like maybe one or two smaller ETFs, and the market does a correction like it's doing now, and you only have $100 to spend. You're now in capital lock because you don't have any more money to spend for this correction. You want to buy it, but you don't have the capital to buy it, and that kind of ties into or adds up to your risk tolerance. Income kind of ties into your capital flow. Are you making enough money to save away? Willingness to and unwillingness to take chances is kind of a personal thing. Uh, there's some people I know who just love to pull the trigger. Just say YOLO, put it all on black on the roulette table, and that's fine if you want to do that. But you're taking a more riskier chance by doing that. There's some that aren't willing to take chances, but if you want to risk it for the biscuit, you got to risk it for the biscuit. You got to put down the money. You got to put it all on black if you want to win. You can't expect to win if you don't bet. You can't win anything if you don't put money on the table. So those are things about your own risk tolerance. And risk tolerance, I tell people sometimes, look how much money you want to spend. And of course, with investing, only put in, this is not for your savings, this is for investing in general. With investing, you only want to put as much money as you're comfortable with losing. And that's with gambling as well. That's my rule on gambling. I only go to the casino. I don't go to the casino that often, but when I do go, I say, this is how much money this is my flat line, this is my absolute maximum that I'm willing to lose. And I go ahead and just bet that. And that's the same way with when I'm investing money. Don't put money away that you're willing to lose. Right? Did I say that right? Only put money into the market that you're willing to lose, that you're okay with losing. That's correct, yeah. And you want to look at your income, kind of figure out, you want to cover your basis, you want to cover your bills first, your cost of living first, and then you figure out then what you're okay with losing. Of course, you want your rainy day fund. After all those kind of like basic needs that you have to pay for, then you start looking at, okay, now how much am I willing to lose with this money I have left over? You should never bet more than your cost of living, I feel. I feel like that's stupid, selfish, and greedy. But, some people want just bet it all. And if you want to take that chance, then do it. Go for it. Yeah, but this is kind of a short episode. But, Jason, I miss you. You're my rock. That's it. For what I'm watching this week, I am watching one of Warren Buffett's top holdings, I believe. He's got a big chunk of the company. He's got 18 million shares of the company right now. That's Store Capital. Ticker symbol STOR. Let me look it up real quick. STOR. They're trading at about $25 a share right now, so it's a pretty cheap company. Let's see their metrics. Their the gluten-free Jason Bessing Insta metrics. They're about a $5 billion company, so they're a small cap. I believe that's in the small cap. Excuse me if I'm wrong. 35 PE ratio, and they pay a 4.61% dividend on a $25 stock, and they've consistently paid dividends. I think I saw up until 2030. I think that's when the the Nasdaq site goes up to, about 2013. But they've been consistently paying quarterly dividends for a while. Um, so Warren Buffett owns this company, or I should say Berkshire Hathaway owns the company. I saw news about when Warren Buffett was moving his assets around, and I saw Store Capital, and I checked it out. I was like, wow, it's a pretty nice company. I was playing it around 20. Let's see. I was playing it around $26, and I sold it for a profit, and it's sold off for a bit. It sold off around $22 around February, around when everybody else was correcting. But since then, it's doing better than the market. I like it. It pays dividends. I figured out the math for Warren Buffett he makes about 20 under 25 million, 23 million in dividends a year. To make his money back, he's got to stay invested for around 17 just under 20 years. So I mean, it's a cheap stock. I'm gonna load up on it. Not a lot. We'll talk about profile portfolio allocation, what you should really do about that later. I'm liking it, so I'm watching it. I've got 2 shares right now. I'm gonna watch it for the week. Um, yeah, I think that's about it. It's been great. It's been a great solo podcast. Yeah, it's been great. My name's Nathan Oliphant, and as always, is it Monday yet?